You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. Today, we're taking a close look at the global market briefing for September 19th, 2025. We're sifting through, quite a bit of material on FX volatility, commodity pressures, some interesting dynamics in trade policy, and of course the geopolitics that are, reshaping risk everywhere. Our mission, as always, is pretty straightforward. We want to pull out the really vital insights, the aha moments from all this market intelligence, give you the shortcut to being well-informed without getting totally bogged down.
And I think if you take a step back, the overarching theme this morning is really the sense of collision. You have on one hand this very slow, cautious monetary normalization starting in Asia-Japan specifically. And that's running right into, continued strong performance from the US dollar. Plus, you layer on top a high degree of geopolitical uncertainty, which is fundamentally shaping how everyone views risk. That tension is really driving things.
Okay, a collision. That makes sense. Let's unpack that, starting with maybe the biggest surprise this morning. From Asia, the Bank of Japan, the rate decision itself keeping rates unchanged at 0.50%. That wasn't exactly a shocker, right?
No, that was widely expected, telegraphed well in advance.
But here's where it gets really compelling, I think. The surprise announcement that the BoJ is actually going to start selling its ETF and J-REIT holdings.
That's the crucial distinction, absolutely. Keeping the rate steady, that's status quo. But deciding to unwind those specific asset purchases, the ETFs and the J-REITs, those Japanese real estate investment trusts they accumulated during the yield curve control era, selling those off, that's a major step.
Why is it so significant?
Well, it signals the BoJ is serious. Not just about ending easing, but about actively reducing the market distortions they created. It's normalization through the balance sheet, even before another rate hike.
Okay, so what was the immediate market reaction? Because that sends a powerful message, even without a rate change.
It really did. That announcement immediately strengthened the yen, just for a bit. It pushed USD JPY down to a session low around 147.2. It just demonstrates how keenly the markets are watching for any genuine sign of tightening.
Right. And what about Governor Ueda? The main narrative for pretty much every other major currency is still the, overwhelming dominance of the U.S. dollar.
Yeah, the dollar just keeps pushing, extended its winning streak into a third session. The DXY dollar index is holding firm.
And where is DXY sitting now?
It's holding just below that recent peak, near 97.60. That level's a key resistance point. And the fact the dollar can just hover right below it really highlights this narrative of, superior relative U.S. economic performance.
And you see the flip side of that globally. The euro, for instance, it softened again, slipped back from recent highs.
Precisely. There just hasn't been enough sustained positive news or momentum out of the Eurozone to really fight the dollar's pull. But sterling, the pressure there feels even more pronounced and specific.
Right, it's trading below 1.35 now. And it's not just dollar strength hitting the pound, is it?
No, not entirely. The briefing points specifically to domestic factors, too.
Yeah, the UK public borrowing figures.
Exactly. Weak borrowing numbers came out. And that's really intensified fiscal concerns for Chancellor Reeves, especially ahead of the autumn budget. When the government needs to borrow more than expected, it just puts pressure on future spending, on credibility, the whole picture.
So you combine those domestic worries with the broader dollar strength.
Yeah, you see why sterling is struggling to find support right now.
Okay, so summing up FX, yen's the only major firmer today thanks to that BoJ surprise. Everywhere else, it's the U.S. dollar show. That collision you mentioned is definitely playing out.
Clear as day.
All right, let's transition then. Move over to commodities. We're seeing that mixed risk sentiment reflected there too, right? Tight ranges.
Yeah, pretty subdued overall. Crude oil, for example. WTI is hovering around $63.40. Brent near $67.40. Not much movement.
What's keeping the lid on energy prices? There are still ongoing supply concerns in the background.
It feels like pure political headline risk acting as a sort of ceiling. Prices seem constrained, maybe not by immediate supply shifts, but by President Trump's Fresh call for countries to stop buying from OPEC plus members.
That rhetoric again.
Yeah, it just creates uncertainty, exerts some psychological downward pressure. It seems to be capping any upward move that supply tightness might otherwise justify.
And speaking of energy geopolitics, Europe seems to be scrambling a bit on its supply strategy.
It really is. What's fascinating here, and potentially quite impactful, is the report that the EU is considering accelerating its phase-out of Russian LNG purchases.
Accelerating? By how much?
Potentially bringing the deadline forward by a full year. Now, that raises a huge immediate question about European energy security.
Definitely.
It signals political determination, for sure. But it means European nations have to lock in alternative, reliable, long-term suppliers much, much faster than they planned. That creates intense competition in the global gas market.
Okay, shifting from energy to metals. Gold's trying to recover a bit.
Yeah, attempting to claw back some recent losses, trading near $3,650 an ounce as the dollar eases just slightly off its absolute peak. Copper is still kind of stuck, range bound, just below that $10,000 per ton mark.
But the real story in metals, the one that plugs directly into global industrial plans and, frankly, anxieties, it's cobalt, isn't it?
Absolutely. Think about the energy transition, electric vehicles, battery storage. It all heavily relies on battery tech. And cobalt is vital for that. So we have this critical supply chain risk bubbling up from the Democratic Republic of Congo, the DRC. Reports suggest they're weighing an extension of their current cobalt export ban.
An extension? For how long?
For at least 2 more months, is the word.
Why does a potential 2-month ban extension from just one country rattle the chains so much?
Because the DRC isn't just one country in this context. It's the world's dominant source of cobalt by a huge margin. So a prolonged ban, or even the threat of one, highlights this really dangerous single point of failure in the global manufacturing system.
So if battery makers can't get cobalt,
it immediately puts pressure on EV production timelines worldwide. If you're watching markets, this isn't just a niche commodity story. It's a potential vulnerability alert for major auto manufacturers, battery makers, energy storage stocks. The ripple effects could be huge.
That potential cobalt crunch flows perfectly into our final segment, looking at trade policy and the broader geopolitical uncertainty. Let's start with trade negotiations. In North America, we're seeing efforts to kind of circle the wagons, right? Solidify the regional bloc.
That seems to be the goal. Mexico and Canada pledged to strengthen the USMCA agreement.
Yeah.
The new NAFTA, essentially. And they're also launching a new bilateral security dialogue. Plus, Canadian PM Carney is apparently adjusting policies specifically to boost North American competitiveness in this, well, more unstable global environment.
A clear strategic move, trying to build resilience regionally.
Exactly. But then you shift focus back to the U.S. trade approach. And the policy picture gets, well, let's call it complex. There's a fascinating duality.
Duality? How so?
Well, on one hand, you have lawmakers reportedly putting together a bipartisan bill to grant very targeted relief, exempting something specific, like coffee, from existing tariffs. Consumer-friendly, industry-specific.
Okay, so micro-level relief. What about the macro approach?
That's where the other side of the duality comes in. The administration is apparently exploring using the revenues from existing tariffs, the money collected to fund new domestic projects. Things like factory construction, infrastructure.
Using tariff money to fund domestic spending, that sounds like a shift.
It's critical because it potentially redefines the entire purpose of the tariff.
Go on.
Historically, tariffs are often seen as leverage, right? A tool to pressure other countries into changing their behavior. But if the U.S. starts using those tariff revenues as an ongoing internal funding mechanism for domestic industrial policy, well, then the tariffs stop being temporary leverage. They risk becoming a permanent feature of the budget, part of a long-term economic strategy.
And that macro strategy seems almost directly at odds with the micro relief for something like coffee.
Precisely. It's that exact duality. Very targeted, specific relief happening alongside this potentially aggressive new form of industrial protectionism funded by the tariffs themselves.
Yeah.
That captures the strange moment we're in.
Okay. Let's shift finally to the global security flashpoints that are creating that broader uncertainty we keep mentioning. Middle East.
In the Middle East, the situation remains tense. Israeli Prime Minister Netanyahu reiterated their stance. Military operations against Hamas will continue until all their stated objectives are met. No sign of de-escalation there.
And in Europe, the focus seems to be on defense.
Very much so. Council President Costa has invited EU leaders to an informal summit scheduled for October 1st. the specific agenda, reinforcing European defense capabilities and coordinating ongoing support for Ukraine. So that commitment to long-term funding and strategic unity in Europe remains a core political theme.
And the Iran factor continues to simmer in the background, too.
Indeed. We saw Iranian officials issue a pretty stark warning. They said any reimposition of European sanctions against them would be viewed as purely political and, crucially, would risk escalation. That direct link they draw between economic policy, like sanctions, and potential military or diplomatic tension. It's a perfect example of how geopolitics feeds directly into market uncertainty in the region.
Right. So let's try to bring this all together. We've covered a lot. For you, the listener, trying to navigate this, what are the key takeaways from this deep dive?
I think it circles back to that collision theme we started with, FX. It remains broadly dollar supportive, even with the yen getting that temporary boost from the BoJ's balance sheet move. Commodities look relatively steady, but they are incredibly sensitive to headlines, whether it's OPEC plus rhetoric from the U.S. or these single-point geopolitical risks, like the DRC cobalt situation, which really highlights genuine supply chain fragility for key industries.
And underpinning it all
is that backdrop of uncertainty, driven by, well, that confusing duality in U.S. trade policy, plus intensifying defense priorities in Europe and the Middle East. Honestly, this whole session feels absolutely primed for volatility.
And that volatility injection might not be far off. We are heading into a potentially significant news flow later today, aren't we?
Yeah, two key events scheduled. That high-level call between President Trump and President Xi, and also some important North American data releases.
Okay, so here's something specific for you to think about, building on everything we've discussed. Consider this. How might that narrative around North American competitiveness, the one Canada and Mexico are trying to build, how might that change based on the economic data we get later today, especially if, say, U.S. data comes in much stronger than its neighbors, and maybe even more profoundly, that U.S.-China call? What kind of seismic shift could that initiate, specifically regarding the U.S. administration's potential plan to use tariff revenues to fund domestic factories? Will that idea be softened in negotiations, or could this call somehow cement that funding mechanism as a new, maybe permanent feature of the trade landscape? Definitely keep an eye on those policy signals.
Lots to watch.
Indeed. That's all for this deep dive into the global market briefing. We'll catch you next time.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.